I'm joined by Tom Nolan, Chairman and CEO of Spirit Realty Capital. So, Tom, this year, Spirit received an investment grade rating from Moody's. That joins investment grade ratings already from Fitch and also S&P. What does this mean for your capital structure going forward?
Well, it means we're an investment grade company, and that's a great outcome for the company. That was a strategic goal of ours. To be recognized by the rating agencies is to have a balance sheet that is consistent with the best-in-class REITs. That's something we've been working towards, and to get those ratings again was something we set out for. Tactically, being able to access the unsecured debt market is incredibly efficient, and for a company like ours, that we're an acquisitive company, we're adding properties, to be able to access the unsecured market is I think allows us to run our balance sheet and the whole company therefore more efficiently.
Yeah, I'll say you're adding new properties. There were 100 in the third quarter alone, and you mentioned the company's excitement about the opportunity to buy new properties in this environment. Why is now the right time to be aggressive?
I don't know if I'd phrase it as being aggressive. I think we take a pretty simple approach, although I think it's a time-honored approach of are there good risk-adjusted returns available in the market? And what I think I was trying to relay on our last earnings call is that we did see a significant amount of supply of really good property in good industries, but importantly, they were available at good prices. In other words, when we match up our cost of capital, the risk associated with owning it, and the implications of buying it as to a bottom line growth, they all came in. They all came together, and so those situations aren't always available. And as we were sitting there, and as we've been sitting there this year, they have been. So we've taken advantage of it.
And looking around the corner at 2017, what would you say are Spirit's biggest concerns or challenges?
That's another thing we've worked hard at, is to try to make sure that we're not exposed to any one given thing. We're not exposed to credit markets or individual property types. We really seek diversification in every way that we can find it: property type, balance sheet, industry that we're in. So I don't look at anything and say, well, I've got this specific risk that I'm losing sleep over. And I think that puts me in the camp of just general economic conditions. What's 2017 going to have for us in terms of interest rates, product availability? So very general economic conditions, I guess, is things that I certainly think about. But I'm happy to say I don't think we have too many individual things within the portfolio that are causing us much concern.
I want to ask you about the supply of properties in the triple net sector. Do you see more assets coming under that triple net sector umbrella in the next year?
I do. I think that's one of the most exciting parts about leading a company in the triple net sector. There's been a number of studies done by folks probably a lot smarter than I am, but in our sector, when you look at the REIT industry, and it's certain of the asset classes I think are classified as mature, regional shopping centers, apartments, and the like. The triple net sector is really just, I think, at the beginning of the growth phase. It's much more institutionally accepted now, and there are literally, depending again on who's doing the studies, there are hundreds of billions of dollars of property held in the hands of owners who have other uses for their capital. And I think there's going to be terrific transference of real estate ownership in a truly win-win type of arrangement.
Well, thank you so much for your time, Tom.
Terrific. Thanks for inviting me.
And for more on this and other REIT news and analysis, be sure to visit REIT.com.